Hello and welcome to the Zagga weekly videos. I hope you've enjoyed the content that we've been sending you. We've had some very good positive feedback, so please keep that coming. And of course, I hope that you're all doing well, keeping safe and taking care as we navigate our way through the COVID crisis. A couple of weeks ago, we did a live video chat with Tom Cranfield, who's one of our credit managers. And as a precursor to that discussion, I spent a few minutes talking about the Zagga credit process. We did not record that part of the discussion, and we've had a few queries about the process. So I'm going to talk about that today. If you are one of the people who joined us in that conversation, then you may not find this video of huge input to you, but of course you're welcome to keep listening, or alternatively to use the opportunity to click off now. So moving then to the Zagga credit process, let me just say a few words that'll help you understand how we look at a loan, how we assess a loan, and what it takes for a loan to go from being a mere inquiry into something that has been approved. We get loan opportunities sent to us from a variety of sources. These are generally from accredited commercial brokers, from a number of accounting firms, law firms, tax planners, financial services firms, and also directly from borrowers with whom we have prior relationships. Those transactions or opportunities or scenarios, as they're often called in the market, are sent to Steve Levy, who's responsible for looking at all incoming loan opportunities. And he has a general look at the deal. He and I will probably have a discussion around the deal. If it's something that we don't like, we will make up our minds immediately. And we've learned long ago that if it is something that doesn't fit within Zagga's requirements or within what Zagga comfortably feels it can write or it can get its investors to invest in, we generally don't waste time, we send it away. If the scenario has some merits to it, but also has some cons to it, we will often talk to our credit team, and I'll say a little bit more about the credit team, get a heads up from them, and once we've had that heads up, then we'll go back to the introducer with a view. So assuming that a loan scenario comes in and it's something that we're interested in pursuing, we'll have a look at the general scenario, we'll see how much information we have, we will ask the introducer or the referrer for more information, and once we have enough information on the transaction, we get our credit team involved. Now we effectively have 4 managers within our credit team, 2 internal and 2 external, and of course, you met Tom, who's a member of our external team, together with his business partner, Frank and James. And you've also heard of our internal team, Bill and Colin. So Steve and I have no ability to influence the credit on a transaction. Once the deal has gone through our hands and we recommend it to credit, it is up to credit to take a view. Credit will assess the transaction in many instances, especially if the transaction is particularly complicated. That will require them to go to site, to meet with the borrower, to meet with counterparties, to vet all supporting information, to relook and very often redo a feasibility, and generally to undertake a robust due diligence into the transaction. If after all of that conversation, credit is happy with what they see, then credit will give us the high-level terms for the transaction, and we will convert those terms into an offer letter or a term sheet, which will then be sent to the borrower. If not directly, then to the borrower via their introducer. Once the borrower has accepted those terms, the deal is loaded up on our platform. A digital copy of the borrower agreement is sent to the borrower and or their introducer and is executed by the borrower. At that point in time, it may well be that some of the conditions associated with the transaction are still to be met. And depending on what those are, we will go about fulfilling those conditions or go about getting the borrower or his team to fulfill the conditions. Generally speaking, every single transaction we write will always be subject to a full valuation being done by an independent bank-approved valuer, and this is generally the time when we would ask for that. We also want the transaction to be documented by our panel solicitors. So this is the time when we would get our panel solicitors to document the transaction as well. And if there are any other documents or conditions to be met, this is when this is going to happen. So at this point in time, we've received the scenario. we've set out a term sheet, the term sheet has been accepted, the borrower agreement has been issued, and the lawyers are starting to produce the documents. Now, on the assumption that everything goes well, the documents will be produced by the legal team, those documents will be sent to the borrower's legal team, and all of the conditions regarding those documents will be met, and we will get to the point in time when the document is executed. Now, the document always has to be executed by the borrower in front of his solicitor. That is in order that his solicitor can verify his identity in terms of the verification of identity requirements, and also in terms of the AML CTF requirements, the anti-money laundering, counter-terrorism financing requirements. At that point in time, the borrower may be required to give us a certificate of legal advice from his solicitor, or he may have to give us a certificate of financial advice from his financial advisor, and we will collect insurance requirements and those things. Once we know that the documents are going to be signed, the settlement date is set, and the loan is set up on PEXA, which is the electronic exchange ready to be registered. Before the loan can be settled, we are required to pay money from our trust account to our solicitor's trust account, and our solicitor is required to give us a solicitor's certification letter confirming that the loan meets the conditions. So during the credit process, we will have put up a term sheet on our platform. We would have matched that term sheet to the investors. We would have collected money from the investors, and we'll have that money sitting in our trust account. Now, before we pay away any money to a borrower, our solicitor sends us a letter, which is effectively a certificate confirming that the loan has been written on the conditions set out in the original term sheet. The other thing that happens is that our directors' credit committee also looks at the final documents in terms of the term sheet and the payaways, and confirms that they have no objection to the loan being written. Once all of that has happened, we give the instruction to our solicitors to sign off the deal on PEXA, the money changes hands, the loan becomes live on our system, the borrower gets their money, we pay the investors their interest if it's going to be paid up front, the deal is loaded on the platform, we upload certificates of investment for each investor, a statement for each investor, and of course a statement for the borrower. So in a nutshell, that's the process. In summary, it's a very robust process. It cannot be influenced by Steve or I. There are Chinese walls and there are segregation of duties involved. The people looking at the deals are highly experienced and know exactly what they're doing. There are a number of checks and balances in the process all the way along. And if anything happens at any stage of that process that we're not happy with, we will not continue with the transaction and we will withdraw it. So far, we've written more than 88 transactions. They're all performing exceptionally well. Everyone has had their money back, and hopefully we'll be able to do that for a long time to come. I hope you found this interesting. Please let us know if there are any other topics that you would like us to cover. Thank you for listening. Goodbye. Take care.